Ohayou gozaimasu. Good morning, everyone. It's my pleasure to be here with you today to discuss U.S. high yield. Thank you for your time. Recall, once the enormity of the pandemic was realized by the financial markets in March, U.S. high yield dropped 20% over the span of 3 weeks. This was the fastest collapse on record. Then the Federal Reserve unleashed unprecedented support for the economy and for the markets. It provided trillions of dollars of support to individuals and to businesses. And for the first time ever, it even began investing in high yield ETFs. This provided direct liquidity and support, but it also created stability and confidence in the capital markets, allowing companies to access significant capital to boost liquidity. As slide 1 shows, there was record new issuance in U.S. high yield on a year-to-date basis, which has been used by companies to mainly refinance existing debt. As a result, debt maturities have been extended, with less than 5% of total debt outstanding coming due over the next 2 years. This is the lowest amount of debt coming due over the next 2 years on record. And it's important because it greatly reduces the risks of defaults. As a result of all this, the market has largely recovered. Year to date through October, the market is about break even, and it's up over 31% from the bottom on March 23rd. I think the economic backdrop in 2021 will be supportive of good performance for U.S. high yield. There are a number of factors that will be supportive, particularly after what I expect to be a fairly challenging winter. First, with the new administration entering, I expect there to be increased fiscal stimulus to bridge the economy through the winter. Second, as vaccinations start to be given in volume across the population, this should bolster market confidence and be supportive of increased economic activity. Third, as mentioned earlier, companies have extended their debt maturities further out than ever before. The result is the expectation of a dramatically reduced default rate experience. As you can see on slide 3, the trajectory and rate of defaults now expected in the market, as forecasted by Moody's, has been greatly reduced. In April, Moody's was projecting default rates to rival the record level reached during the Great Financial Crisis. Now, the absolute level and trajectory have both been dramatically reduced, further supporting performance of U.S. high yield from here. Finally, in a world of historically low rates, investors will continue to need yield, and U.S. high yield is one of the largest, most diversified, and established asset classes that give investors the opportunity to earn a yield approaching 5%. Our strategy is rooted in bottom-up fundamental research capabilities with a long-term perspective. We overlay this with a top-down risk management and portfolio construction approach to ensure the portfolio is constructed in a way that is consistent with our macro views and our overall views on valuation. At times, we'll be aggressively positioned because we think it's the right part of the credit cycle and valuation is inexpensive. Other times, we'll be more conservative given our views. Currently, I think valuations are fair, fundamentals are mixed, but importantly should get better over the next year. Our portfolio is constructed around overweights that offer strong downside protection with the chance for good long-term performance through credit improvement. As you'll see on slide 4, our overweights are in industries such as banks, utilities, and cable TV. These industries represent those types of great risk-adjusted return opportunities. One example that I'll highlight is a very low risk but good total return opportunity in Sprint. Those who have been following this fund know that Sprint has been a top position for me for close to a decade. Recently, it completed its merger with investment grade rated T-Mobile, and Sprint bonds still trade at a significant discount to T-Mobile, which should narrow over time. Knowing which bond to own is also really important. I own the longest dated Sprint bonds that cannot be redeemed before the year 2032. As a result, these bonds now trade at 153 cents on the dollar, and I think there's at least 10 more points of upside as the discount to T-Mobile bonds narrows. At the same time, we are modestly underweight some of the cyclicals where we just don't see compelling value. However, there are pockets of opportunity. One example is Hertz, the car rental company. We did not own any of the bonds prior to bankruptcy, but we did start to buy the bonds at under 40 cents on the dollar. based on my belief that post-pandemic, this will continue to be a very valuable franchise that competes in an oligopolistic industry. The industry has been shrinking supply. Eventually, demand is going to recover, and I see lots of upside in those securities. Overall, because I'm constructive on US high yield, we are slightly more aggressive than the benchmark because we think the lower credit rating tiers will outperform going forward. As a result, as you can see on this slide, our yield to worst is higher than the benchmarks. These are challenging times to invest, and there are a lot of fluid dynamic changes in the high yield marketplace. Fidelity is the oldest and one of the largest players in US high yield. That means we have unparalleled resources, including 24 dedicated high yield analysts, 7 dedicated traders, 3 dedicated attorneys to focus on workouts and other legal issues. And of course, we leverage the broader global Fidelity platform consisting of hundreds of analysts around the globe. As you can see on slide 6, there are many opportunities available for an investor like Fidelity to generate solid alpha over time. On the left-hand side, you can see 50% of the market is made up of credits that have been downgraded over the last 12 months. Percentage of the index made up of fallen angels or investment-grade bonds downgraded to high yield. This is currently an opportunity approaching $200 billion and expected to grow. These are big, complex companies that take a lot of time to understand, and we have a distinct competitive advantage because we're already covering through both our equity and our investment-grade debt divisions, so we can move quickly and opportunistically to take advantage of the dislocations in the market. Lastly, on the right-hand side of the chart, you can see the dispersion of yields is still very elevated. 80% of the market has a spread more or less than 100 basis points outside of the average. This dispersion is much higher than average. It means it's very much a market made for security selection. Given our resources and access to management, this is the type of market that Fidelity should excel in. Arigato gozaimasu. Thank you very much for your time and your interest today. Again, thank you so much for your support and interest, and we look forward to talking to you in the future. Thank you.